This is an Uncovered Japan Company research report on STI Foods Holdings, ticker 2932. STI is a vertically integrated maker of chilled, ready-to-eat seafood delicatessen for Japan's convenience stores. In the next few minutes, we will look at why its operating model earns unusually high margins, and why customer concentration and raw material costs make the case more nuanced than a simple value screen. At the report date, STI traded on a forward price-to-earnings multiple of about 10.9 times, with a 3.85% dividend yield. The report estimates return on equity at 17% for fiscal 2026, alongside a 46% equity ratio. Its research score is 11 out of 20. Valuation is the stronger axis, while imported fish inflation, liquidity, and supply-demand conditions are important constraints. STI's product is easier to understand through the supply chain. It sources seafood, processes it, and makes chilled deli, rice ball fillings, and canned products for convenience stores. Its 5 chilled food factories produce roughly 350,000 to 400,000 meals a day after orders are confirmed. That build-to-order model limits finished goods inventory, but it also ties volume tightly to the orders and merchandising choices of its key customer channel. The income statement shows both the attraction and the caution. Revenue rose from 26.3 billion yen in fiscal 2021 to 38.6 billion in fiscal 2025. Operating profit was 2.56 billion yen in fiscal 2025, after rising in the prior 2 years. Reported net income was helped by a one-off negative goodwill gain, so the research emphasizes operating profit and cash generation, rather than treating the net line as a clean run rate. Over 5 years, revenue compounded at roughly 10.9% annually. The more important line is operating profit, which fell 11.7% in fiscal 2025, as fish costs and a pricing misstep weighed on margins. The report's fiscal 2026 revenue estimate is 40 billion yen. The next question is not whether STI can sell Fish-Deli, but whether it can pass higher raw material costs through without sacrificing demand. STI's Moat is operational. Modified atmosphere packaging extended the shelf life of chilled deli from about 3 days to about 10, which improves the economics of convenience store distribution. Large lot sourcing, direct import relationships, 5 production plants, and process know-how add further barriers. The report describes this as a niche monopoly, but it is a moat built on execution. Product quality, volume reliability, and supply chain coordination must all work every day. Cash flow is one of the more reassuring parts of the case. Operating cash flow has averaged about 2.1 billion yen across the period. Free cash flow dipped in fiscal 2024 when the company invested in the Kansai plant, then recovered. The build-to-order model limits finished goods inventory and helps working capital efficiency. That financial flexibility matters because the business needs to invest while it manages a volatile commodity input base. Management's long-term ambition is around 100 billion yen of revenue, versus 38.6 billion in fiscal 2025. The Kansai plant adds capacity, while the Ajinohama Fuji retail business, overseas activity, and home use products offer possible growth paths beyond the core channel. Those options are real, but the report treats them as unproven. The immediate strategic test is pricing and volume recovery in the existing chilled deli business. The valuation chart puts the 10.9 times forward earnings multiple in context. STI was valued much more richly around its 2020 listing, then derated as earnings became more cyclical and guidance credibility weakened. The 5-year average is about 12 times, while the historical low was 7.5 times. A low multiple alone is not a thesis. The potential re-rating depends on evidence that margins and guidance can recover. Against peers, STI stands out for its estimated 17% return on equity, but trades around 10.9 times forward earnings. The report's view is that the market prices it like a conventional seafood or convenience store vendor, rather than a higher return niche operator. The discount is not arbitrary. It reflects 7-Eleven dependence, founder concentration, thin trading liquidity, and the credibility damage from recent guidance misses. The report's own 3-year scenarios range from about 23% downside in the bear case to 44% upside in the base case, and 117% in the bull case. These are illustrative estimates, not forecasts or price targets. Their spread captures the key variables: whether STI restores margins through pricing and utilization, whether the core customer channel holds, and whether growth initiatives become meaningful. The concise conclusion is that STI Foods has a differentiated operating model and an unusually strong niche position, but it is not a risk-free defensive food stock. The most useful indicators to follow are Q2 volume and pricing, operating margin recovery, 7-Eleven concentration, raw material costs, and founder succession progress. The report frames the opportunity and the risks together. It is not a recommendation to buy or sell the shares. For a much deeper look, visit the free deep dives at uncoverjapan.com. We go beyond the headline numbers to cover the business, financials, valuation, risks, and catalysts. This video is for information and education only. It is not investment advice or a recommendation to buy or sell any security. Always do your own research.